Welcome everyone to this EU GreenWeek session entitled Redirecting Sustainable Investment, Green Bonds and Beyond. I am Elisa Galvan-Mondier and I will be introducing our speakers. The clock is ticking in humanity's race to net zero, and meeting the EU Green Deal's climate and environmental goals requires an unprecedented amount of resources. And this means deploying financial instruments which prove effective in reversing climate change, protecting us and our Earth's living systems. Linking to the pollution topic of the event and the recently adopted Zero Pollution Action Plan, many of the sources of CO2 also produce pollutants. Therefore, harnessing and protecting nature's cycles and capture power, be it carbon, phosphorus, nitrogen, in the air, water, and soil, are some of the key shared solutions to both health-harming pollutants and climate change. But the bottom line is that to avert climate disaster, we need to stop adding CO2 into the atmosphere and drive capital towards this goal. Should we be focusing on critical issues such as cement and new buildings emissions or refrigerants, for example? How much of our annual emissions are capital markets funds deployed helping us reduce in order to get to net zero? Although still a niche market of 8% in the larger scheme of the total global bond issuance, the sustainable bonds market is set to continue its exponential growth. The so-called green bond rush, expected in the coming years, should be supported by the evolving EU legislation on sustainable finance. Our objective with our time today, limited time, is understanding what is happening in the sustainable bonds and capital markets to help bridge the investment gap. And we'll look at the knock-on effects and prospective financial instruments and critical challenges in redirecting capitals towards a radical industrial and technology model shift, and what changes need to be made to face the future effectively. A market pioneer and head of sustainability funding at EIB, is currently leading the transition of the bank from the old to the new criteria set out in the EU taxonomy regulation, with the latest addition to the Sustainability Awareness Bond in respect to other environmental objectives on top of climate action being the protection and restoration of biodiversity and ecosystems. High green lending targets and supporting the application of the upcoming EU Green Bond standards are on the agenda of ALDO and Europe's Climate Bank. The standard will be adopted by this summer and provide further stimulus to the asset class, following a year's consultation process. We will hear the ins and outs on this directly from Sven Gentner, head of unit at DG FISMA at the European Commission. Which leads me to introducing you to our third speaker in line today, Bernard Windisch, head of unit performance-based budgeting at the European Commission. As his job title suggests, with his team, he evaluates the performance of policies and money based on specific challenges. And he is responsible for preparing the Green Bond Framework document, under which the European Commission will issue 250 billion euro worth of green bonds to finance next generation EU. Presenting the landscape in China and helping shape a vision for a shared approach, Professor Yao Wang was involved in joint work with the EU on the white papers on the need for a common language in green finance, co-authored by Aldo's team at EIB and the China Green Finance Committee back in 2017. Yao Wang is the Director General of International Institute of Green Finance and holds various leadership positions in the finance and banking industry in China. She was recently appointed a Chief Technical Advisor for UNDP China BioFin Project, Biodiversity Finance Initiative. Finally, our last speaker will be Serena Fatica, who leads the economics research stream on green bonds and at the Joint Research Center, supporting EU policy. Thanks to the scientific contributions her team has made to financial literature since 2018, she will today provide answers to help us understand whether green bonds are effective in greening the economy and their potential as a sustainable finance instrument in the long run. Simple bookkeeping to the audience. Please submit your questions or comments by going onto the Slido channel and select Room 2. If time allows it, the panelists will be happy to answer these questions at the end of the session. And now to my question to the panelists. Given our climate, social, and health urgencies, citizens are counting on major transformations to take place. How do we make sure the sustainable bond market lives up to the promise of effectively catalyzing trillions towards a net zero, pollution-free, and regenerative future we can all thrive in? Can you please tell us about the state of play of the market and describe what is the greatest challenge we face moving forward? Aldo, the floor is yours.
Thank you very much, Elisa, and good morning, everybody. It is a pleasure to be with you today. I think that a way to frame this whole debate is to start by clarifying what green bonds are. So green bonds are use of proceeds bonds. So bonds that whose proceeds are allocated to projects that have relevance in the field of green. And in definition of the UNEP inquiry, green means environmental. Now, sustainability has a broader spectrum, includes also social objectives, and this is what has led to the development of the market in the direction of social bonds that are, again, use of proceeds bonds in this area. Sustainability bonds are bonds, use of proceeds bonds, that cover both environmental and social objectives. Now, when you want to allocate in a reliable, transparent, and accountable manner funds to certain types of activities, you need definitions. And the big issue in this field is the fact that until recently, definitions do not exist. Lack of clarity dominates still partially the area of sustainability. And this is essentially the reason why, upon an impulse from the G20 in September 2016, the European Commission decided to intervene in this field. And what effectively the taxonomy regulation has been established for. I will not preempt, of course, Sven's input in this field. I will just try now to move to the reasons why the EIB can be taken as a test case. The EIB is the Bank of the European Union and inaugurated the green bond market in 2007 when Europe, with the Berlin Declaration, clarified that the fight against climate change is a pillar of European integration. At the same time, the Energy Action Plan was launched with strong focus on renewable energy and energy efficiency, and the EIB started to scale up activities in this field. So we thought from the very beginning in the Capital Markets Department that it would have interest for the market to monitor the actual delivery of the higher objectives that the EIB was setting in this field. And in order to provide the market with valuable information, we decided to put in place an infrastructure that would provide that reliability in the description of how the actual deployment of the fund, the disbursements, not only the loan signatures, would unfold in the course of time. This is the reason why we have come to play a role in the development of this market that, starting in 2013, 2014, after the financial crisis, also added the dimension of impact investment. So originally the focus was just on the quantitative monitoring of the disbursements based on definitions that were set by the issuers. From 2013 and 14, investors started to recognize the relevance of this market and to ask for more information about the criteria, about the impact, expected impact from the projects that were to be financed. So the EIB took initiative as chair of the steering committee of the Green Bond Principles, but eventually it was very soon clear that it was necessary to have a deus ex machina, a higher official authority to take initiative and establish a more detailed precision with regard to these aspects. So all of these initiatives and the contributions also of the EIB to the process are summarized in a document that was approved by the board of directors of the bank in November last year, which is called the Climate Bank Roadmap. In this document, the EIB makes 4 extremely strong statements in this field. The first one is that the EIB intends to increase the share of green finance, climate action plus other environmental activities to more than 50%, to at least 50% of its new operations by 2025. The strong second statement is that the EIB will measure the delivery of these objectives by putting in place a tracking methodology that aligns with the framework established by the taxonomy regulation. So it will use the instruments that the European Commission is putting in place to measure the delivery of these objectives. Third point, the bank will reflect to capital markets, to international investors, this progressive alignment via a gradual extension of scope of its sustainability funding instruments. That is to say, climate awareness bonds that have a focus on climate change mitigation, and sustainability awareness bonds that have a focus on other environmental and social objectives. So we have already made clear to markets in this context that it is our plan to align with the EU Green Bond standard that is expected in this area. Now, do we need, and this is the final message that I would like to provide in these opening remarks, do we need to wait for the actual entry into force of the taxonomies that are currently being discussed? Well, no. Because the entry into force of the taxonomy regulation has established an enabling framework of logical principles that permit an issuer like the EIB that has technical expertise also in-house to, in fact, anticipate this process under the condition that the criteria that it applies to the reclassification of its lending activities align with the logic of the taxonomy regulation. This has kick-started a whole process at the EIB, both on the side, first of all, on the side of the lending activities of the bank, and at the same time, we are reflecting this in the documents and the communications that we provide to investors in a gradual how could I say, process of development of the infrastructure that is required to live up to the requirements of the new regulatory framework. So this is, I will leave it here. This is the starting point, and give the word to the next speaker.
Thank you, Aldo, for that. Sven, over to you.
Thank you, Elisa, for the introduction, and hello, good morning, everyone. Well, I wanted to talk a little bit more about what Aldo already mentioned. This is our plans to establish a green bond framework at the Euro level. As you've both said, we have huge challenges ahead of us. We've set ourselves very ambitious goals in terms of CO2 reduction in the European Union, which is necessary because we all know that if we don't meet those goals, we will face a very difficult environmental situation. But when you start breaking down those needed over the next 10 years, over the next 20 years, is a huge shift in our economy from a not sustainable to a sustainable model of doing business. And what is also needed, of course, is huge amounts of investment that will allow this shift to happen. These huge amounts of investment we will only manage to reach if we really fully mobilize capital markets to support this transition. This is why the European Commission already several years ago proposed the Sustainable Finance Action Plan, which basically tries for every phase, for every step of capital markets to make sure that sustainability considerations are fully taken into account. We're establishing rules for issuers. We have established rules for financial market participants, how they have to disclose sustainability-related aspects. We're establishing new rules for advisors. And we're now also in the process of establishing, if you want, labels or orientation marks for investors to clearly be able to see what is green, what is sustainable, and what is not. And the Green Bond Standard will play an important role here. What is new about this Green Bond Standard is that it will be tied to the taxonomy. So that means we can clearly define what is in scope and what is out of scope. That's different, I think, to the existing market-based standards that are already out there, which have been helpful. But we are, in a sense, trying to establish now a benchmark through this green bond standard, if you want a gold standard in the market that can clearly say, based on the taxonomy, what is sustainable and what is not. So the first thing is that the use of proceeds will be fully tied to the taxonomy. The second element is we nevertheless want to leave it up to the market to decide whether this standard is adequate for the operations or not. So we don't want to try to establish this as the only standard, but in a sense, as I said, as a benchmark, also as something that will hopefully have an effect on all the other standards out there to increase the level of ambition. The third element is that we also think that the framework for reviewers who actually look at what the companies actually do, or also for sovereigns, needs to be moved further, because what we need in the years going forward is trust, is reliability. This market will go on growing. We've seen very strong growth rates over the last few years. It will go on growing, but we need to make sure that things don't go wrong and that trust is not undermined, because this could have catastrophic consequences, not just for the ones who do things wrong, but for everyone. And we need this market to go on growing at the rates that we're seeing now. So these are the elements that we want to include in the standard going forward. It still has to be agreed by the College of Commissioners. We're planning to come with a proposal still before the summer break. You know the system in the European Union, so we will then go to Parliament and Council and negotiate this. We're already in good contacts with the Slovenian presidency, who will take over soon, and they will make sure that we'll hopefully move forward fast. The same in the Parliament. There's a lot of interest, there's a lot of appetite, and I do hope that this standard can then play a really good and constructive role in this transition, in this huge shift that we will be seeing and that we have to see over the coming years. Thank you.
Thank you, Sven, for sharing with us this the long-term and strategic vision. Bernard, over to you, please.
Thank you very much, Elisa, for the introduction, and good morning, colleagues. We have just heard from Sven the huge challenges, the huge investment needs, and I think it has also been mentioned by Aldo. On top of what Sven has already mentioned, last year we all know the pandemic hit, and slowly through that first stage of the pandemic, the idea kind of came, the idea of build back better. And I think what happened in the EU was that everybody pulled together and brought up Generation EU, which is in a sense the biggest investment program that was ever financed through the EU budget. In total, together with the traditional budget, it's 1.8 trillion in 2018 prices. So it's a huge amount of money, and key of the main program that this is going to be financing, which is the Recovery and Resilience Facility, are the twin transitions, so green and digital. Today, green is the one that is concerning us most, and there was a decision taken that basically the Recovery and Resilience Facility would earmark 37% of financing towards projects that fight climate change. Now, in a way, that is then the key building block for the green bonds that are going to finance Next Generation EU. It's already been mentioned in the introduction, up to 250 billion. I think the up to is very important to us, because I think the president said 30% of NGEU is going to be financed through green bonds, but it's still not clear precisely what the number is going to be in terms of bonds, for two reasons. One is that there is a pickup question in the program, so not all the resources have to be picked up. And secondly, it's obviously absolutely crucial for the credibility of the green bond program that our eligibility standards are high. And that means that I think there's the internal decision taken that it's more important to be strict on the standards of eligibility rather than reaching the 30% target. So at the end of the day, if we are not quite at 30%, then I think from a political perspective, this is less important than ensuring that we are financing actually green we are building, so Aldo has mentioned already the kind of distinction between green bonds and sustainable bonds. As you will be aware, the EU had last year its first social bond issuance program, I should say, number of issuances, the SHORE program, which went very well. And we are building basically on that experience also for the green bonds. So in the sense, at the moment, we are preparing a best practice green bond framework. And we are currently in the second party opinion provider process, which is part of the standard as they currently exist. But I'd like to kind of point and come back a bit to the question of the eligibility, particularly also because it shows a bit of the challenges that we are facing and why this program is a bit different from most programs, even if we look at sovereign programs that exist these days. And I think what needs to be understood is that the Recovery and Resilience Facility is a very specific program and it has a very specific construction. So I think there are 3 points that I want to make here. We are not actually at the EU level financing projects. That is not that unusual in a sovereign context because you are financing programs usually, which are types of projects. And each project will be potentially rather different, but there are some framework conditions around in the program that you can kind of rely on. Here we are not even financing programs. We are actually financing member states, or we're giving money to member states who then put in place a recovery and resilience plan that has been approved between all parties, to then actually put in place the programs that then finance the projects. So I think that's the first point. So we are actually rather far removed from the actual project. The second point is the timing is extremely tight. When the Recovery and Resilience Facility regulation was adopted in December, it stated that the plans should be submitted by the member states at the end of April. I think now we have more or less received all of them in official format. So I think there have been 9 months of discussion with member states in depth on the content of these plans, ensuring that they are kind of correctly set up, that they fulfill, amongst other conditions and criteria, the 37% target. They are going to be now going through an approval process. So the Commission is going to assess and then the Council is going to approve them. Which means that basically by the time that summer is over and we are starting the implementation of the Recovery and Resilience Facility, all the conditionality around it is actually fixed. So that means basically that at that moment in time, we have a legal framework that is no longer going to change. We have basically the regulation, which was adopted in December, and we have the plans that were adopted then in the course of this summer. And that means, again, that we need to rely basically on the conditions that we have managed to set up in that framework. Now, coming to that framework and the conditions that are embedded in there, I think when the Recovery and Resilience Facility regulation was adopted in December, there was a long discussion and a kind of detailed work on an annex of that regulation. And that annex contains a rather interesting document, which is basically a list of criteria of activities and criteria and whether they are therefore climate relevant or not. So this annex is actually the way that all the different measures in the plans are going to be marked as green relevant or not. And that framework then also will underlie the eligibility for green bond eligible expenditure. So this document is very important, and I think it is because already at the time we looked at the tech report that is underlying the taxonomy regulation delegated act, which at that point didn't exist, obviously, and tried to kind of incorporate some of the important substantive conditions into that document. And I'm glad to say that the co-legislator worked with us very clearly to do that. And as Aldo already pointed out, the taxonomy regulation also obviously puts together a principle framework that is usable. And here, I think very important was the do no significant harm, which has also been operationalized in the context of the Recovery and Resilience Facility to ensure that actually whatever we finance is also not going to go in the wrong direction. So even if it's not relevant specifically for green, it should obviously not bring anything to harm in the environment. So putting all these elements together, it means that the investments and the measures that member states have put in the plans have been assessed on the basis of this annex, and to ensure that we are basically coming to an overall financing towards climate target of 37%, which roughly corresponds to 30% with a little buffer of NGU. So at the end of the day, using that as the asset pool underlying the green bond issuance framework, we are confident that we are going to be able to issue a sizable percentage of NGU, hopefully 30%, as green bonds during the 6 years to come, during which the Recovery and Resilience Facility will be implemented. Thank you.
Thank you, Bernard. We are all stewards of one planet. So I would like to turn to Yao. What can you tell us about the green finance market in China?
Okay, thank you, Alyssa. And it is a pleasure to be here and contribute to the discussion. In China, I think green finance has attracted a lot of attention from policymakers and market players, especially after the 2030 and the 2060 carbon goals were announced last September by President Xi. China's green bond market has grown to become one of the world's largest since its launch in 2016. However, when it comes to the energy transition, the financing gap is still significant. According to a recent study from Tsinghua University, to achieve the China carbon neutrality target, a new investment of around 140 trillion yuan will be needed between 2020 and 2050 in the energy system alone. So this goal cannot be achieved without financial markets, and green bonds are one of the best financing tools to provide the required investment. While green finance has contributed to development of the green industry, the financial resources that could support the transition of big emitters are still insufficient. Notably, in China, the Sorry, I lost. Can you hear me now?
We can hear you, although we cannot see you, but we can hear you.
Okay. So to reach the 2060 carbon neutrality goal without creating too many stranded assets, it's crucial to introduce innovative financial tools, specifically focus on supporting the transition of the fossil fuel industry. For example, sustainability-linked bonds, SLB. Few years ago, 7 energy companies issued China's first SLB with total value of 7.3 billion yuan. Among them were China's biggest fossil fuel companies, including China Huaneng, Datang, and the Shanxi Coal Group. So even though the interest rate is below average, the bonds went very popular. 43 investors bought the bonds with over it shows the potential and demand of the market for this type of financial products. And the reason why SLB are so popular on the market, I think it is mainly because of their special characteristics. The proceeds do not have to go to green projects in particular, but can be spent on general corporate purposes as long as the issuer can achieve predefined sustainable objectives. So these objectives are measured through predefined KPI, measured the sustainability of the issuer's operations. So on the other hand, the standard performance target, SPT, are the quantitative evaluation targets that present the material improvement of the chosen KPIs. So the level of ambitions for SPT is the most important part of the instrument. So such system ensure that issuers are held accountable for meeting their predetermined KPIs and making incremental change to become more sustainable. Of course, there are a few improvements that could potentially increase the flow of financial resources towards a more sustainable economy. One of the biggest obstacles is the lack of access to key information for evaluating the company's sustainability, such as mandatory ESG disclosure could help regulators make efficient policy decisions and incentivize businesses to make informed supply chain management decisions. This would favor ESG compliant activities. Now, currently, a few companies in China disclose ESG information on a voluntary basis only. So we expect the policy announcement regarding mandatory ESG disclosure to be released by China's Securities Regulatory Commissions and other regulators later this year. So I believe that ESG information disclosure and greater transparency will become crucial to sustainable development in the future. Exchange centers can also facilitate cross-border green investment and harmonizing of international green finance standard. In 2017, Luxembourg Stock Exchange and Shenzhen Stock Exchange, with technical support from our research institute, jointly launched the first cross-border green bond and index. So I think this index can help attract foreign investors to participate in the Chinese green financial system and support green industries in China. As China's capital market open up, there is increasing potential for responsible international investors to influence standardized ESG disclosure in China. Additionally, to ensure that more financial resources follow to sustainable financial products, it is important to clarify what counts as sustainable investment. So creating common taxonomies and harmonized standards would facilitate a cooperation between project owners and investors and encourage foreign investors, just like other experts also mentioned. So it is worth mentioning that cross-border investment in green financial products between China and the EU has been very vibrant in recent years. At the moment, China now is working with the European Union to adopt a common green taxonomy later this year, and implement a joint recognized qualification system for the environmental business. So it is very welcomed and important step to strengthen financial cooperation and facilitate foreign investment between European Union and China. So I hope that we can gradually overcome the challenges, focus on the opportunities, and fully exploit the potential to develop green and sustainable finance in China and Europe. Okay, I'm stop here, Lisa. Thank you.
Thank you for that, Yao. Serena, at JRC, you have monitored and gathered new evidence looking at green bond holdings and debt capital markets in the EU member states, especially in the midst of major turmoil and crisis like COVID. What can you tell us about this, please? Over to you.
Thanks a lot, Elisa, and good morning, everyone. It is really a pleasure for me to be here this morning and be able to present some scientific and quantitative evidence on green bonds from the research that I've been coordinating at the European Commission's Joint Research Center. In fact, let me say first that most of this research was actually developed in support to the policy process, and notably in the context of the work of the technical expert group on sustainable finance that was set up by the Commission, specifically the subgroup on the EU Green Bond Standard. Now, drawing on the JRC research, I would like to discuss three aspects of green bonds this morning. Two that relate more to the financial side of this instrument, right, strictly speaking, and one that instead pertains to the real side, if you want, that is the implications and the effects of green bonds for the economy and the environment. So I hope you can see my slides because I cannot see them. If this is the case, and I see Elisa nodding, then I would ask to go to the next slide, please. So green bonds are a financing instrument, right? So the very first question we asked ourselves is, do green bonds imply or lead to lower borrowing costs for the issuer? There is mixed evidence out there, both among practitioners and in the economic literature. And against this background, our answer to this question is, it depends. Like very often, unfortunately, among economists, the answer is, it depends. In our case, however, this is motivated by heterogeneity on the side of the issuer. So it depends, but there is a very good reason for that. It depends on the type of issuer. So what we did was actually sampling a very large number of green bond issuances worldwide between 2007 and 2018. And what we found was that supranational institutions and non-financial corporations actually benefit from a greenium when they issue a green bond. But this is not the case of financial institutions. So we argue.
May I interrupt just 1 second, because we're looking at the wrong slide. We need the previous slide to be shown. Are you still talking about borrowing costs?
Correct, yes.
Yeah. Thank you.
Yeah, I'm sorry, I'm not controlling the slides, so I'm relying on the organizers for that. So financial institutions, in contrast to non-financial corporations and supranational institutions, do not benefit from lower borrowing costs when they issue a green bond, right? We argue that this is because, it might be because green-minded investors cannot immediately link the green bond issued by a bank or a financial corporation to a concrete green investment project. The fact that it is really investors that care about the greenness of the investment, and then in the face of a relatively small supply of green bond can drive price up and then yields down, seems to be confirmed by the fact that the greenium is higher for green bonds that have an external review and that are issued by return issuers. So issuers that tap the green bond market more than once. And this is why we say that credibility and reputation matter a lot on this market. Next slide, please, which is about the resilience of green bonds in times of crisis. Excellent. This is the second financial aspect that I want to focus on, and it has to do with the very recent market turmoil in the aftermath of the COVID-19 outbreak. So when you look at market indices, like the one that you see here from Bloomberg, indices of green bonds and next to indices of comparable conventional bonds, so non-green bonds, investment grade, and for similar maturities, well, you see that they are actually not behaving very much differently immediately before the COVID-19 outbreak. But when the pandemic hits, and the crisis hits heavily financial markets, you see that they are really pointing to a very different performance. In particular, green bonds seem much more resilient than conventional bonds. We still focus on the demand side, right? And we look at how the demand from institutional investors might have contributed to this different performance. In particular, we find no evidence of significant difference in sales of green versus conventional bonds in what we call normal times, so right before the COVID-19 outbreak. However, when the crisis hits, compared to conventional bonds, we see that green bonds experience lower sales in institutional investors' portfolios, all other things being equal, right? This is particularly striking for the case of mutual funds, which we know might be subject to runs during market turmoil because they face withdrawal or redemption request by their client. In particular, mutual funds sell more of conventional bonds in this period, but sell less of green bonds during this period. And this is true not only for funds that are reported as sustainability concerned, so what we call ESG investors. The conclusion from this is that green bonds, like sustainable investments, seem to be really more resilient in systemic crisis. The further implication, very important, is that investors and also final investors, retail investors, do not need to forego performance to help foster the green transition. Then next slide, please. Moving slowly towards my last point, which is about the effectiveness of green bond finance. And this, as I said, has to do with the real implications of green bonds. So we started here from a stylized fact that we saw in the data. It is actually pointing to the fact that corporate green bonds so far have had a strong focus on climate change mitigation. Roughly 80% of the amount issued so far by corporations is really directed partly or fully towards projects that can be classified as having an impact for mitigating climate change. So what we do here is looking at the trajectory of company-level carbon emissions for green bond issuers, comparing that with the trajectory of similar bond issuers that have never tapped the green bond market. And we find actually that green bond issuers decrease their carbon emissions after issuing a green bond. So both total carbon emissions and scope 1 carbon emissions. We also find that the decrease in emissions is more pronounced, significant and long-lasting for green bonds issued for non-refinancing purposes. That is, it is easier for us also from a methodological point of view to identify additional investment rather than marginal investment to existing projects. And also we find that the reduction in emissions is larger in the case of green bonds that have an external review, which seems to corroborate the point on the benefit to investors, the perceived benefits to investors from increased transparency. And also that the reduction in emission is larger for green bonds that are issued after the Paris Agreement. And this is an important sign of an increased awareness for the urgency to act against climate change, also on the side of the corporate sector, the non-financial corporate sector. And I will leave it at that. Thanks a lot.
Thank you, Serena. Thank you for that. And now, with the 17 minutes we have left, we can move on to questions. So my first question is, underwriters and market players see that there will be a sharp increase in the market in sustainability-linked bonds, so general purpose bonds versus use of proceeds bonds. What are your views on this, and what are the challenges you see for the asset class in light of what we've discussed: credibility, accountability, transparency, and the new harmonized standards? Aldo, would you like to take this question to start? You're on mute, Aldo. Can you unmute your mic, please?
So, apology. In our perspective, sustainability-linked bonds are, an interesting product that can, in fact, further crowd in more market participants. But they are not user proceeds bonds, as you correctly say. That vis-a-vis general purpose bonds without the sustainability link component, they introduce some additional targets that are defined by the issuers, but they are not user proceeds bonds. Our conviction is that, however, the role of user proceed bonds is more determinant in terms of the transformation of the economy. So this product can represent a valuable engagement instrument for many issuers that may not, for one reason or the other, have the possibility to issue user proceeds bonds. In principle, the sustainability link component could be also linked, for example, to the proportion of to targets like the proportion of, I don't know, taxonomy compliant assets on the balance sheet of the issuer, and therefore establish also a link to the broader objectives of EU legislation on sustainable finance. But definitely for the EIB, the use of proceed bonds remains the focus of issuance going forward.
Thank you for that. Sven, would you like to comment or jump in?
Sure. No, I'm happy to comment on this as well. Maybe first of all to say, as I said in my introduction, the standard, the EU green bond standard that we want to establish, will be a voluntary one in the sense that it's not going to be the only standard out there. And I think it's exactly for this reason that we're seeing that there are lots of different types of standards and frameworks being developed at the moment, which is probably a good thing because, as I said, we need to see a lot of growth here. We need to see a lot of development. And I think probably no one is in a position to say now what the market will look like in 10 years or even in 5 years. So I don't think we should overdo it at this point in terms of trying to regulate everything and anything. And I think it's good that different things are being tested in the sense of how can they work? Is there appetite for it? Are they reliable? Do they maybe provide certain solutions for specific problems? In terms of the standard that we want to establish, it's a use of proceeds standard. I think it can also help with the transition because, as you know, in the taxonomy, there are also activities recognized that can help certain industries transition from brown to green. So also the EU GBS can be used in that sense. I think that's important to note. And what is also important to note is that I think the European Commission will invest a lot of energy over the next few years in helping even further with this transition to recognizing it, under the taxonomy, to maybe coming with specific frameworks to recognize transition activities or give a possibility to highlight them in financial markets. I think it's something which we're also going to talk about a lot when we come with our renewed sustainable finance strategy, also still before the summer break. So yes, of course, we have a need for standards that help with transition. I think the green bond standard will be able to do that because the taxonomy does it. But nevertheless, I think there is also space for experimenting and space for development because a lot of solutions will be needed over the next years to meet the challenge that we'll all face.
Thank you for that, Sven. Bernard, would you like to jump in and maybe speak about other financial instruments or safe haven also instruments, if this?
Sure. No, very happy to come in. I think my feeling here is that there's, in a sense, from the perspective of a large issuer, let's put it that way, I think our contribution, we need to think a bit about our contribution in this space. And I think there are a number of points here. So the first one is obviously that having the EU in this space will actually attract further attention to the market. I think this is a good thing. We need to therefore also have a responsibility to ensure that we are actually kind of providing a best-in-class framework for the issuance, and that we are as transparent as we can about everything that is related and linked to it. So in that sense, I think this is obviously very important to us. It is also true that if you think about the space of the investment needs that we have, there's obviously a large diversity of risks associated to those investment needs, and I think one of the there are two interesting aspects to this. The first one is that as a sovereign, or in this case super sovereign, we obviously, as I already mentioned, we are quite far away from the project base. So at the end of the day, whatever we do will be averaged over a large number of different projects, and therefore also over a large number of risks, which is in a sense a good thing. Obviously, also given that we are super sovereign and we have an extremely attractive rating, this will provide a large pool of highly rated green bonds out there. So that is also interesting because that should give the possibility, particularly when we look at large asset managers, to balance potentially taking risks on some specific projects, which could be financed through green bonds. Perhaps also in spaces that was mentioned by Serena, that obviously there is climate on the one hand, which kind of hoovers up all the financing at the moment, whereas there's a lot of other areas that might need financing. There is obviously a possibility to balance risk portfolios from an asset management perspective as soon as you have a large pool of safe assets to balance. So we do hope that in that sense, our presence in the market will encourage also the redirection of flows on the green space towards a bit more risky projects in other parts of the market. Thank you.
Thank you for this, Bernard. This leads us to the second question, in fact. As shown in the diagram provided by the JRC and Serena, the breakdown on green bond projects by environmental objectives shows only 4% of amounts issued are allocated to projects tackling circular economy, waste, pollution prevention and control, and protecting biodiversity and ecosystems. Can you tell us about the action levers or redesign processes with both business and finance and the market participants that we are seeing or that you would like to see in order to redirect sustainable investment and unleash its transformative potential? Yao, would you like to answer this question?
Thank you for your question. It is true that not much proceeds from green bonds are spent on environmental protection projects. But we have to know that green bonds is just one of many financial tools to finance circular economy or pollution prevention and prevention and control projects. Besides, environmental pollution has drawn a lot of attention from policymakers long before the creation of green bond concept. And we can also use in fiscal expenditure special laws to support relevant projects. However, considering significant needs for investment in those sectors, more financing channels will be needed in the future. While the world's attention is focused on addressing climate change, we should keep in mind another major challenge that humanity faces: biodiversity loss. The current level of biodiversity conservation financing is insufficient and accounts for less than 20% of the amount needed to stop the biodiversity loss. So increasing the necessary level of support can be seen as a challenge, but it is also an opportunity. So the reform regulatory framework, proper incentives, and the new market structures can effectively catalyze financial flows from the private sector into biodiversity conservation. In addition, innovate finance solutions such as debt for nature swap can be very effective tools that can bring more funding to conservation projects. To increase the global engagement in biodiversity protection, all the stakeholders must realize the value of natural resources. So the best way to ensure that environmental services are valued in our economy is also to assign them a monetary value. So at the moment, China is pioneering in GEP, which measures the economic value of all ecosystem products and services supplied to human being annually. So I think this is also a positive development, and I hope that for the biodiversity finance will draw more attention. Okay.
Thank you, Yao. Serena?
Thanks, Elisa. Just a couple of remarks on my side on your question. So first of all, the pie chart indeed refers to corporate green bonds, right? I have the feeling that it's just a feeling, right? That if we pull projects out of the databases, right? Projects financed with green bond issued by governmental institutions like national governments, but also subnational governments, like it is the case in the US, where there is a very large market for municipal green bonds. These relative shares may change, and in this I fully agree with Bernard that the Commission's issuance and governmental issuance that we are witnessing now in the EU will clearly help shifting this strong focus on climate change for the better. I mean, to include also other environmental objectives that are being tackled by policies right now. Then my other remark concerns really two of the percentages in the pie chart. One is what we classify as climate change mitigation partly. What does it mean? That a lot of projects that are reported on the use of proceeds by issuers are conflate actually a number of different investment projects that can be classified under more than one category. So we cannot really attribute, right, how much is going to finance the different objectives. And in this transparency, like the one which will be brought about by the EU Green Bond Standard, will really help also the life of the researchers working with those data. The other quick remark is about the 11% that we found in the amount issued, that for which the use of proceeds, the projects financed by the green bonds are not disclosed. Now, this hides a very important fact that actually disclosure on the use of proceeds has been growing constantly during time. At the very beginning of the market, you could find very little information on the projects, and I think this increasing propensity to disclose on the part of issuers is really both a cause and a consequence of the success of the green bond market. Thank you.
Thank you, Serena. Since we're almost out of time, in 30 the main message that you would like the audience to take away. So Aldo, shall we start with you again?
Okay, thank you very much for this primacy advantage. Well, I think that the most important message that I would like to convey is that the approach that the European Commission has taken in this field with the taxonomy regulation is one that does not focus on the type of financial products, but rather on the ultimate effect. A financial product is sustainable if it finances activities in the economy that are sustainable. This is a very important element because it reverberates in all areas of finance, tying up finance with the real economy. And green bonds is just the tip of the iceberg. This is what I would like to highlight. the bond market, the international bond market, is a very reactive market. It's less sticky than other markets. It's looking forward. And by creating this organized enabling framework, the taxonomy regulation and the upcoming regulation on the EU Green Bond Standard are going to facilitate how could I say, knock-on effect from the green bond market to other markets. The IB is a typical test case, since the funds from our green bonds are allocated to loans that live up to the requirements of the taxonomy regulation. So this is, I think, a very, very important element. There is a clarification process that is ongoing, and the green bond market is playing a kind of litmus test function in this.
Thank you, Aldo. Thank you. Sven, over to you.
I keep it short. Two things. I think we have managed to put in place important building blocks already, and we're doing so in terms of the transition and the regulatory framework for it. But if we look at the goals that we have to achieve, we're nowhere near where we should be. So I think the level of ambition still will have to go up, and it will take everyone, market participants, regulators, stakeholders, to make this happen. So we'll be in it for quite some time together, I think.
Thank you, Sven. Bernard, 30 seconds or 15 seconds if you can. 2 words.
It's a super exciting time in the market, to be honest, because there's a lot moving right now, and we are in a forward-looking process. So I think it's very exciting.
Thank you. Yao, your turn.
We need to keep in mind that there are sufficient resources in the financial system to support sustainable finance, and to close all the financial gaps. We need a policy framework and introduce innovative financial products. Okay.
Thank you. Serena, 1 sentence.
1 sentence. I agree with Aldo. Green bonds are really the instrument that may pave the way for other financial assets. They make investors aware of the real impacts of their financial choices.
Thank you. Thank you to our speakers, to the audience. On behalf of the organizers, thank you all for watching and participating. And with that, I close this session.
Thank you very much.